Yeah, look, I think it's a glass partly full on the incredibly strong job gains we've seen, the incredibly strong consumer spending. Consumers tell pollsters they're really pessimistic, they're really depressed, everything's awful, and then they go out and spend a lot of money. We don't know how long that'll last, but it keeps lasting month after month. And just overall pace of the economic recovery, that's all on the positive side. Inflation is at a 40-year high, is on the negative side. Real wage growth, inflation-adjusted wages are falling at the fastest pace they've fallen in 40 years. So this is a real problem for people. For most people, they had a job last year, they have a job this year. What matters to them is that they're getting a once-in-a-generation pay cut, real pay cut. Going forward, how does the Fed navigate this? There is a happy story where this inflation was all transitory, and Team Transitory was right. They just sort of were 12 months off. I think that's possible. I think it's a 25% chance. I think it's worth hoping for that. But there's a lot of inertia in this. Inflation expectations are higher. Wages lead to prices. Prices lead to wages. And it's, even if we had a recession, that might take half a point or a point off of our inflation, might not get it to where the Fed wants it to be. And so that's what worries me.
I think there's also one other thing playing out right now. Consumer balance sheets went up tremendously with all the government stimulus. You had the average savings account go up from about $400 to about $2,000. As I look out, as others think about this, if inflation stays where it is, those savings and the spend continues, those savings go back down by the end of this year or the beginning of next year to that $400 or $500 level. And I think at that point, you're going to really see, we are already seeing reduction in spend, lower income levels for sure. That's moving up to middle income right now. So I think we've got numerous interweaving things that are happening right now that it's not just consumer spend. A lot of that was government stimulus, and that's not here anymore.
And I think it's important to make the point, this might be a moment for a little government humility. Think about what happened, in April, I guess it was, of 2020. With the lockdown, economy looks like it's crashing. We're worried about markets freezing up. And there was a massive response, right? And it was bipartisan. It was almost unanimous in Congress. I was part of it. And we stood up these facilities by the Fed. But we ended up having about a $2 trillion hole, and we filled it with $6 trillion of spending.
Yeah.
And at the same time, we had a massive expansion of the money supply, and we had the Fed buying $1.4 trillion worth of bonds, mortgages and treasuries at an annual rate. And they kept doing it a year and a half easily after we were clearly out of the woods, right? We had 30% GDP growth in the third quarter of 2020. And there we are still buying these bonds. My point is, I think we did way too much. And now one of the ways we pay the price for that is this inflation that we're living with.